Well, it may have been unthinkable not that long ago. For the first time in 20 years, China is no longer the main seller of goods to the United States. That title is now held by Mexico. The change highlights how global trade is evolving after recent supply chain issues, political disputes, and of course the pandemic. So what does globalization look like now, and how competitive is Canada in this new environment? Derek Burleton is Deputy Chief Economist at TD, and he joins us now for his perspective. Thank you for stopping in.
My pleasure.
So let's start. We'll get to Canada in a second, but let's just kind of get a sense of where we are right now. How significant is it, to start with, that Mexico has usurped China in that role?
Yeah, I know it made huge headlines when it happened last year. Tracking it back, this was a story that began really in 2017. That's when China's export share to the U.S. peaked at 21%. Mm-hmm. By far the largest supplier, and then year by year it's been coming down, now down to 14%. So that's a good third drop in terms of that relative share. Mexico's gobbled up a good, almost half of that. So it's seen about a 3-point jump. And so I do think it's notable. What's been driving it clearly, when you think back at the time, right after Trump took office, imposing tariffs against China, clearly throwing up the tariff wall. And then since that, it's been one event after the other. Geopolitical tensions have picked up globally, the regionalization of trade, the pandemic, which just put the emphasis on the need to have reliable supply chains. And here we are today. So I do think it's a big event.
Yeah, if we can pull up the chart, we can take a look just to see just the trend downwards, and you can see up there. Do you expect this trajectory to continue, or do you think it's going to stabilize at this point?
Yeah, you know what? I would have it creeping up, I think, or creeping down rather in the case of China. So I don't think we're all of a sudden going to hit it and we're going to see no further decline. Is it going to go to zero? No, I don't think so. But certainly, these general headwinds in the way of China exporting to the U.S., the importance of NAFTA and USMCA. These aren't going to go away. So I would expect, trend is your friend in the near term.
For those of us who have a few years and a bit of a memory, and I do, is Mexico, I should say, is its star rising again just because of proximity and the more established, perhaps, industrial base that it has right now? Just maybe give us a sense of, what you see in Mexico and what's growing there.
Yeah, we don't hear a lot about the Mexico economy.
Yeah.
The fact that we haven't, I think, is a good thing. A lot of emerging markets, when they're in the news, usually it's because of bad news, capital flight and all that kind of thing, high inflation. But Mexico has been very quietly chalking up good, healthy growth, 3% last year, track for 2% this year. It's dealing with many of the issues that the advanced economies are dealing with. Core inflation, that's mid-single digits. It's got high interest rates, starting to think about taking them down. So that's kind of the economic backdrop. Mm-hmm. In terms of trade, yes, I think that's where a lot of its growth's been coming from. It's been coming from the production of motor vehicles, exports to the U.S. That's been certainly providing that foundation. Now, is it the new China? I think that's a stretch. I wouldn't say that. When you think about still how important China's economy is in terms of global trade, it's still about 6 times Mexico. It's over $3 trillion in annual exports. So Mexico is making share, but from a global perspective, certainly not there, even though it is within the North American market. And, so I think it's not China. I think when you look at the diversity of Chinese exports and their areas of growth, a lot of the green tech, solar panels. So Mexico has a less diverse export mix than does China. So, and I think where this gets muddy, this whole story, we talk about the U.S. de-risking from China, looking to Mexico and Canada for more exports. Where it gets muddy is that the U.S. is also looking to ASEAN economies for more exports, the Vietnams of the world. Mm-hmm. And China, in turn, is supplying more to these economies. So this de-risking does get muddy because we call these economies sort of linking economies. This is Mexico, where, they're open for business and they're not that, in terms of who they deal with. They're so those economies. So in terms of de-risking, maybe less than what meets the eye just looking at direct trade shares.
It's interesting. I want to bring that up because it's a great point. If we take a look at this chart, which comes from a report from your team, China still being the world manufacturer. So it's not just that China is exporting less to the States, but China is still exporting more to other places as well. Like they're both diversifying at the same time.
They are, and this is the regionalization of trade, the friendshoring that's happening. Look at China going after Middle East export share, not just in Southeast Asia, but really across the world. Russia, of course.
Yeah.
So it's been busy building its own ties. So this is where you get a bit off track if you think just because Mexico's export share is rising within the North America, that's because China's really falling by the wayside, because it isn't.
What about China's own internal domestic, issues? I'll say, their economy has cooled off quite a bit. They've had some real estate issues. The government has been stepping in as they do. Well, it's a controlled environment anyway. But how much of that is going to influence maybe their trade flows or how they're managing things?
I do see it being a separate issue. I think a lot of China's problems right now are domestic, tied to the property sector. Now, clearly there is a link, but meanwhile, their export sector's been holding up reasonably well. Of course, it's been hit to some extent by a global slowdown that's been in place for, a year or two, but it's holding up quite well. Its issues are more the domestic side, the spending, the lack of confidence. Now, what's interesting is that, that certainly doesn't help the global economic outlook, because China's still a very important part of it. We worry about its impact on commodities, albeit we're seeing offsets on the supply side in areas like oil where supply has been cut back. And some of the geopolitical tensions are helping to keep commodities well supported, even as China's seen its growth slip down probably as low as 4% in the year ahead, which is very weak. So, that's certainly one thing. But one thing that I think is a very much a silver lining is the fact that there is overcapacity within China's export sector right now, and that's exporting some deflation globally. So we worry about Middle East, some of the supply chain pressures, because trade has to be rerouted and stuff. But that is a deflationary impulse that right now isn't such a bad thing. So a lot of moving parts there, but overall it's still being quite impactful.
How is Canada trending in terms of what it exports to the States?
Well, it had been pretty tough sledding for a while for Canada, seeing a real decline, particularly in manufacturing share in terms of exporting to the U.S. Mexico had been stealing our lunch. China and other Asian economies. Good news is for Canada, we've seen that reverse modestly. We've seen about a percentage point increase in market share from the lows of 2017. So it's been a modest increase, and a lot of it has been oil. I mean, really, it's been an oil story. I mean, food products, a couple of primary metals have helped.
Yeah.
Autos haven't helped. We've seen a downtrend. That's where Mexico continues to steal our lunch. But overall some good news. And I do think that MCA agreement, Canada is within the tent in this near-shoring, friend-shoring trend, and it's helped the economy to kind of scrape off its lows.
It's interesting because I was just, again, you detail in the report, I think our share of energy imports going into the States went from, I think, 41% in 2017 to 58%. That's pretty high. But Mexico's went up as well. I'll say in parallel, not by as much. So this is, again, it's a resource story when it comes to Canada again, it seems, yeah?
It is, and I don't think that's going to change when I look, say, to this year, with Trans Mountain freeing up more capacity, more export. Some of that will make its way down to the U.S. I think Canada's going to be a leader in oil production. So if anything, our share accelerates in Canada. I think we've got a reasonably competitive exchange rate. Again, being within the tent, fairly strong U.S. performance will help. So the export sector within Canada should have a decent year, I think, in 2024. And
decent year in 2024 based on that, but when you start thinking about politics, I'm not going to ask you to make a prediction on the election, but tell me just the things you think about in terms of how Canada will perform as an economy, say 24, 25, with this election and the policies that could come from it.
Yeah, I mean, it's a big uncertainty, of course. Two very different parties. I think one thing, the deficit doesn't seem to be front and center on either sides, but different policies in terms of tax changes. Some of the tax changes that Trump supports, for example, amount to about a $6 trillion lower tax burden relative to Biden.
Very stimulative.
Well, because a lot of his tax cuts coming up for renewal, Biden would allow a number of them to lapse. Trump would pretty much renew all of them, plus add to some. So that's one thing, but of course the trade policies can be quite different. I mean, we know that Biden, like many countries, they're looking after their own interests first, and there are irritants with Canada. Trump has floated the idea of a 10% across-the-board tariff. Now, whether Canada gets a carve-out if he were to take office and actually implement it, it's a very open question at this stage. But, and that would be impactful, no doubt. So these are things that, we'll continue to keep our eyes on. Not something I would expect in 2024, but, into 2025, we'll see how the policies evolve from here. And
I have to ask, because when you think about everything you're just saying to me, I just keep thinking that's inflation. That's because you have stimulative economies, you have tariffs. So, it's sounding sticky.
It does sound sticky, which has been an issue, particularly with Canadian inflation. A lot of that stickiness is on the shelter side, but we've seen goods price, unlike the U.S., where a lot of their disinflation's been through lower goods prices. Canada has seen their goods prices actually rise, albeit fairly modestly, close to 2%. But yeah, it's a real worry. What we don't want is a big wave of tariffs. I'm an optimist. I do think we've heard, if it's Trump, for example, the threats are free to come. We were there in 2016, 17. Some of it was implemented, but a lot of it wasn't, and it was threatened. It keeps economists very busy in Canada. So all that to say that, it's something that, it's a risk. I think businesses need to start thinking about the risk, potential risks, but he may go a very different route. We'll see.
Yeah, I've only got about a minute left, Derek, but if I was to ask you just to characterize, the Canadian economy, though, in terms of where you see the strength, maybe just even across Canada, or what's going to be notable for this upcoming year?
Well, the employment numbers, we had those out. We seem to have a fairly good, resilient backdrop for employment. Consumers are still going to be shelling out more for mortgages, so not expecting a whole lot of growth out of Canada. What we need to see is inflation start to come down, and it risks pushing back. We had an April rate cut, but that's certainly looking, particularly after the employment numbers, looking less and less likely. I think the markets have moved on to a June, and I do think that's looking more likely.